The market is currently closed for the regular session on this Wednesday, June 3, 2026, so let us focus exactly on where things stood at the final bell yesterday. Nokia stock, trading under the ticker symbol NOK on the New York Stock Exchange, finished its last regular trading session at $16.85 per share, marking a solid daily gain of 3.69%, or an absolute increase of 60 cents. While the broader public might still look at this company and think of the plastic candy bar phones of 25 years ago, the options market just flashed a massive signal that tells a completely different story. Yesterday alone, institutional traders moved over 73 million options contracts across the tape, with a massive block of 100,000 contracts established for both the July $15 puts and calls. This balanced but explosive options volume shows that Wall Street is aggressively positioning itself for massive volatility, treating this old-school telecommunications giant not as a slow-moving utility, but as a hyper-growth infrastructure play. The general consensus among casual retail investors is that legacy hardware companies are where capital goes to die, slow-moving entities permanently left behind by modern computing giants. People look at the stock and assume its upside is capped by intense competition in European and Asian telecommunications infrastructure. However, the reality on the ground completely shatters this assumption, creating a stark contrast between market perception and true operational performance. Nokia is experiencing a massive fundamental shift due to its enterprise cloud business, which quietly jumped 49% year-over-year in the most recent quarterly print. By partnering directly with heavyweights to develop specialized infrastructure, the company has positioned itself as the literal plumbing for modern data processing centers. This massive divergence between what the public thinks Nokia does and what its actual order book looks like is precisely why the equity has been riding a 5-month consecutive winning streak, recently touching a 17-year high of $17.11. To understand why this momentum is building, you have to look closely at the intraday swings and institutional accumulation patterns that have defined the last few weeks of trading. The daily trading volume has consistently exceeded its historical average of 94 million shares, demonstrating that massive funds are rotating out of overvalued software equities and into tangible hardware providers. When a stock climbs more than 150% in a 6-month window, standard market logic dictates that insiders should be taking profits. Instead, the exact opposite is happening. Regulatory filings show substantial insider buying from high-level executives, including the chief of staff to the chief executive officer, who purchased over 44,000 shares in the open market at an average price near $15.81. When institutional call options are being swept by the thousands and corporate insiders are using their own personal capital to accumulate shares near multi-year highs, it signals to the broader market that the internal revenue projections for the upcoming quarters are likely much stronger than Wall Street models currently reflect. This rapid appreciation has created a fascinating technical setup on the daily charts, pushing the relative strength index into overbought territory near 69, while simultaneously forcing major Wall Street firms to scramble and revise their price targets. Analysts at firms like Argus, Nordea, and Arte have all issued consecutive upgrades from hold to buy over the last 30 days, admitting that their previous models failed to capture the explosive growth in optical and fiber-optic network demand. The macroeconomic environment has also played a crucial role here, as Western governments continue to restrict competitive infrastructure providers from participating in core network buildouts. This regulatory moat has effectively handed Nokia a multi-billion-dollar captive market across North America and Europe, allowing them to maintain an exceptionally clean balance sheet with a financial strength rating of 8 out of 10. Let us pause here for a moment so we can get a gauge on how everyone reading is navigating this sudden infrastructure sector rotation. Comment below how many shares of Nokia stock you currently hold, or if you prefer trading other major technology equities like Apple stock or Nvidia stock instead. It is always fascinating to see whether the community is leaning toward these emerging infrastructure plays or sticking with the classic mega-cap technology leaders that dominate the daily headlines. When you look past the immediate trading frenzy and analyze the underlying business model, the core narrative becomes even more compelling. Nokia operates through distinct segments focused on mobile networks, network infrastructure, and cloud services, generating predictable recurring revenue through massive long-term service agreements with global telecom operators. Unlike software companies that face low switching costs and constant churn, once a country or a major enterprise installs thousands of miles of physical fiber-optic cables and routing hardware, they are locked into that vendor ecosystem for a decade or more. This structural stability is supported by an incredible war chest of intellectual property held by their research division, which continues to monetize a vast patent portfolio covering foundational cellular transmission technologies. Their recent legal victories in international courts, which successfully blocked unauthorized video streaming patent usage by major hardware manufacturers, reinforced just how valuable their underlying technology remains.
The expectation versus reality dynamic becomes incredibly sharp when evaluating the valuation multiples attached to this business. With a trailing price-to-earnings ratio sitting near 95, a traditional value investor using a simple screening tool might immediately label the asset as drastically overvalued. But that's exactly where the surface-level analysis fails to capture the forward-looking reality of the business. The forward price-to-earnings ratio drops significantly to around 36 when factoring in the projected earnings per share growth for the next year, which analysts expect to climb toward 46 cents. This shows that the current stock price is aggressively pricing in a massive operational turnaround that is already showing up in the sequential net sales growth, which is guided to rise between 5 and 9% in the upcoming quarter alone. This structural shift changes how individuals approach self-investing and online investing across various platforms. Long gone are the days when retail traders had to rely on slow institutional brokerages to catch these international turnaround plays. Whether an investor is leveraging the automated tools of Schwab Intelligent Portfolios, utilizing the active trading features of SoFi Invest, or managing a self-directed retirement account through traditional Fidelity investments, the access to global infrastructure equities has completely democratized. Traders scanning for momentum on the Robinhood app or utilizing the deep analytical tools on the Interactive Brokers platform are seeing the same massive option sweeps that used to be hidden behind institutional trading desks. The availability of fractional shares and zero-commission individual brokerage accounts means that even micro-investments can capture the waves of capital rotating out of speculative software and into physical network hardware. Looking forward, the ultimate trajectory of this asset will depend entirely on how reality matches up against the incredibly high expectations now baked into the current valuation. There are clear catalysts on the horizon, most notably the accelerating deployment of next-generation private wireless networks for industrial automation, ports, and smart manufacturing facilities. These enterprise deployments carry significantly higher profit margins than traditional consumer telecom contracts, meaning that even modest growth in this sector could lead to an outsized expansion in net profit margins. Furthermore, the company's decision to divest its lower-margin consumer accessory divisions, such as its residential Wi-Fi box business, shows a laser focus on protecting its corporate cash flow and maximizing return on invested capital. However, a sophisticated market analysis requires looking at both sides of the coin, and there are distinct risks that could break this bullish momentum. Because Nokia operates on a global scale with its corporate headquarters in Finland, it faces constant foreign exchange headwinds and complex geopolitical crosscurrents. Any disruption in global semiconductor supply chains could immediately delay hardware shipments, forcing the company to defer revenue recognition into future fiscal years. Additionally, while the current options market layout shows a massive amount of open interest at the $15 strike price, a failure to hit the upper bound of their full-year operating profit guidance of 2 billion to 2.5 billion euros would give short sellers the exact leverage they need to push the stock back down toward its moving averages. When we synthesize the central insights of this market development, it becomes clear that the tension between market expectation and fundamental reality is reaching a critical tipping point. The old narrative viewed Nokia as a stagnant relic of a bygone telecommunications era, a stock destined to trade in a narrow single-digit range forever. The new reality shows a highly profitable infrastructure heavyweight that has successfully integrated itself into the backbone of global data processing networks, attracting substantial insider buying and massive institutional options activity in the process. While the rapid ascent to $17 has stretched short-term technical indicators and created a valuation premium that demands flawless execution, the underlying structural shifts in enterprise network demand suggest that the broader transformation is very real. Navigating this landscape requires watching the upcoming quarterly earnings release with extreme precision, focusing less on headline revenue numbers and far more on the sequential margin expansion within the cloud and network infrastructure segments.